Just do a quick sound check. Can you guys hear me? Someone can just type in the little question box. Hear me clearly? Great. Thank you very much. Thanks, Jan. Thanks. Guys, thank you very much for the opportunity once again. So this is our first official webinar. Those of you that were scheduled to attend last week, you'll realize that obviously we had some technical difficulties. And what's happened since then, I've got myself a new laptop, a new headphones, everything. So everything's new. So from my side, I sincerely apologize for any inconvenience that last week might have caused you. But we're back on track. So welcome to our first webinar of the year. And our topic today is, what is PSG Wealth's view for 2015? So it's quite an interesting topic in the sense that I always joke and I say my crystal ball's batteries are flat. It's very difficult to try and forecast what could possibly happen because no one can predict the future. But obviously you need to have some kind of view. Okay, so saying that, here's our agenda for today. What we're going to do is look back over 2014 and look at it. If we can pick up any lessons from that. Some of us like to forget it. It wasn't a very good year as such. And then obviously just quickly recap what were the best and worst performing sectors, or shares rather, and then looking forward. And then obviously the main focus will be on PSG Wealth's market outlook as such. Unfortunately, I know some of you guys are looking for tips. I don't have direct tips. We're not in the business of giving tips. We can talk about the market in general and where we see opportunities. Okay. Like we do with every webinar, this webinar is being recorded. Any questions you guys have, just type in the box and I'll try and answer it near the end of the presentation as we're waiting for more people to log in. Okay, great. Okay. So to get started, let me just quickly shoot out a poll and ask you guys, hopefully this doesn't get, last time we did this we all got stuck. What is your view? Are you optimistic, bullish for the year ahead? I know that we're still in January and we have New Year's resolutions, and a lot of us have this feeling that 2015 is our year. But just interesting to see a poll and gives you a feeling where we can take this presentation to. And looks like 70% of you are wary and nervous going forward, and that's exactly where I feel. About 30% of you are optimistic about the year ahead. So yeah, that's quite interesting, huh? So 70% of us are cautious and wary about the year ahead. Okay. So before I do anything, can we just confirm that the poll's off the screen? We don't have this poll. Okay. No, it's still there. We're nervous. Okay. Can someone just confirm the poll's off the screen? You guys don't have the poll because usually this thing blocks. Okay. Hopefully you guys can see my back screen. It's off. Great. Thank you very much. It's nice to have nice new computers that do all this kind of stuff. Okay, so let's move forward. So if 70% of us are wary and nervous for the year ahead, let's quickly just recap what happened last year. So I don't want to go into too much gloom and doom, but let's take it just from a political point of view. So in the context, South Africa is supposed to boast a sound constitutional framework, and I know some of you guys are smoking, so yeah, sure, it's under threat. But the main thing that we can learn from last year, and this is a fact, obviously there is a problem with political leadership, number one, and number two, obviously government's deficiencies. We're seeing already political appointments to state-owned enterprises, or rather interference in things like the Hawks, in SABC, and more recently, obviously, the receiver of revenue, SARS. Okay, that's one side of the coin. Other side of the coin, obviously, we're all aware of corruption in government. Also, that just filters through to business and obviously the broader civic spheres, I would say that. I know that we've got the State of a Nation coming up soon, but the general feeling out there would be a bit of despair. Now, if you look at, we do have a widening budget deficit, we do have weak economic growth, we do have declining private sector confidence, as well as rising unemployment. Those are some of the things out there. And by the way, this presentation, these notes are taken out from a supplement to the Financial Mail at the end of last year, which I found quite interesting. And they were talking about South Africa in 2015. And this particular section was taken from a article called Nobody in Charge. Okay. from an economic point of view, obviously 2009 or 2014 was one of the worst years from a growth point of view since 2009's recession. And obviously a big part of that was obviously the labor unrest in the mines, that five-month labor strike. It was quite violent. Obviously skills shortages, the falling rand on the one side of the coin, obviously with high oil prices was affecting the economy at that point in time. And obviously also we started having load shedding, the faltering energy grid, but also transport constraints at the ports and things like that. Bottom line, we saw 2 sovereign credit downgrades. We're not at junk status yet, but it could change any time. So it all depends. You know, we're at a very crucial turning point. So saying that, from a political point of view or from an economic point of view, there were still opportunities in the market. And some of you have seen this already. Some of you do know that our best performing share last year, believe it or not, was Telkom. From the 1st of January to the 31st of December, the share price went up by 147%. So you must also understand that Telkom came off a low base. They've been having a lot of management strife or management upheaval. Obviously, the biggest shareholder there still is government, hence what I was saying just now. But also there's focus, the business model slowly becoming more concrete, if you want to call it that way. So there's opportunities, but since then the share price has come off a bit. Capitec was up there, Pioneer Foods, Tongard, so a lot of the food companies were there. Surprisingly, Goldfields, some property companies, etc. But our lowest share in this list on 20 was went up 35%, so not too shabby. So there's always opportunity within all that strife. Obviously, on the other side of the coin, we saw mostly the resources stocks. Mazor, Kumba, Lonmin, Impala Platinum, all those kind of shares taking a knock last year because obviously the lower commodity prices, etc. Obviously everybody was talking about Sasol. Sasol's share price has been knocked and it's also still under threat because of the low oil prices and things like that. So a lot of you will be looking at the resource sector and thinking, yeah, the share prices have fallen so far, there must be opportunities here, there's value here, and I agree, there is value in the resource sector. But saying that from a technical point of view, they are in the bear market. So we need to look at a change in trend. I like to have a change in trend, maybe a confirmation that the trend will be changing. So yes, it is mainly the resource stocks and also a lot of to do with the construction sector, the Venge and the Murray and Roberts. And that's got a lot to do with the uncertainty around the investigations, around collusion and all those kind of things. Market doesn't like uncertainty and hence a sell-off in those sectors. But saying that, there's also good value there. There's a lot of value. So you might be nibbling at it. At this point in time, I like to rather add them onto my watch list and wait for confirmation, see that these things are turning around. Okay, so that's a bit of background. Let's move forward. Let's talk about 2015. So this is again from that supplement from the Financial Mail. And in that little article, they're talking about the National Treasury. We're forecasting growth to bounce back this year. Okay, last year we saw growth of only 1.5%. They anticipate the growth increasing to 2.5%, and then obviously by 2017, 3% growth. I personally think it's very optimistic. This is all based on their expectations that the global economy will be growing or recovering as such. So, and obviously our exports will benefit from that. But saying that, we're seeing already that there's better than expected, or slightly better than expected, but we're still seeing lower growth in China. Those figures were released yesterday. But also we're seeing a slow recovery in Europe. And all hinges around the ECB's plans this Thursday, tomorrow, around monetary stimulus. Are they going to be aggressive? And I think if the market is not happy with that kind of stimulus, I anticipate we could have a bit of a sell-off because it's been all priced into the market already. So our local government in this, as such, is anticipating this global economic recovery. But I also believe that they'll have to curb back on their expenditure in the years to come. It's all very well spending the money, but where's the money going to come from? So we've got the budget speech coming up next month, and the expectations that we'll have higher income tax, especially the high net worth individuals. So they have to find the money somewhere, and guess what? Who's going to carry the burden for the country's fiscal burden, rather? Okay, that's one side of the coin. The other side of the coin, obviously, this expectation that's not really happening of spending on crucial infrastructure. That is one thing that's supposed to be happening. We're seeing the roads. The roads are not very good. We're looking at obviously Eskom and the power stations and things like that. Things are very slow in that space. But hopefully we won't have a repeat of the mining and the metal industry strikes last year, as we saw last year, and that obviously should steady the boat this year. But saying that, obviously what's in our favor, and this is the big thing that's going to be talking about for quite a while, is obviously the low oil price will have a disinflationary effect on the markets. We saw this morning CPI figures came out 5.3, I think it was, if I remember rightly, which is within that range of 3% and 6%. And they anticipate inflation to drop further. They anticipate another 1% a drop. So that's on the back of obviously falling food prices and fuel prices. So this is going to help with the consumer. At the end of the day, will have more real disposable income, number one. And number two, obviously, from an investment point of view, you ought to be involved in consumer-facing sectors. The sectors that will benefit from consumer spending. Obviously, it comes to mind as the retailers and things like that. But there are a lot of other sectors that will benefit from consumer spending. So that's what's in our favor this year, obviously low oil prices. Okay. The mining sector, obviously, is still a big part of our economy, a big employer. The biggest challenge here is obviously lower commodity prices, especially on the gold. We've seen gold hovering around about $1,300 now, but it's still much lower. They have plummeted. Last year, with the labor unrest, we've seen a breakup of the Trade Federation, COSATU, and obviously we might see more or new trade unions being formed from that. The biggest challenge is obviously these unions are making radical promises of higher wages and better working conditions, and we're seeing right now at Northern, one of Northern's mines, there's violent strikes happening there, and that's unprotected strikes, so they haven't got permission to go on strike, but they're striking because of the government, well, not the government, the management's policy around sick leave. So something like that, they go on strike. So it's very fickle, put it that way. Okay, anything can spark a strike. But saying that, obviously, the expansion of the expulsion of NAMSA out of the whole COSATU could see a whole change around collective bargaining, and that could set a new precedent in South Africa, which would be interesting to watch. Okay. We just see now also the last week or so, there's this what they call the Mineral and Petroleum Resources Development Bill being sent back to the National Assembly from Parliament. Jacob Zuma was not happy about certain things. Obviously, they'll push this thing very fast through the courts and things like that. But bottom line is they're worried it's going to be they'll be held up in constitutional court. So that's going back. Obviously, the oil sector took a breather because at the end of the day, the government is looking at taking a 20% stake in any new projects free of charge within the oil sector. And obviously, that's creating a lot of uncertainty. So this is the flavor of going forward this year. I think there'll be a lot more uncertainty. We saw a lot of uncertainty last year. And ultimately, that uncertainty transfers into what we call market volatility. And I think overall, we can expect much more volatility this year. So as an investor, buy and hold investor, well, we're going to have a serious roller coaster. As a trader, volatility is great as a trader. But obviously, you have to be very, very astute and very sharp, and manage your risk very closely, your losses. Saying that also, obviously, big thing this year was, yes, we've got low oil prices, which is great, but also we might have more power constraints. We've seen already load shedding affecting all of us, and obviously that does affect companies. I saw over the Christmas period weekends where retailers were closed. Yeah, so electricity supply will be one big problem. Another side is obviously, I mentioned just now, the transport constraints, railway and port capacity. Okay, so this is enough doom and doom. Let's move forward. Let's talk about PSG Wealth's market outlook. So first of all, looking at a local market, this is PSG Wealth's view. They see our equity market is still slightly overvalued. There are certain pockets of the economy of the market very expensive. You can look at from a valuation, be it PE ratios, be it price NAV or PEG ratios. There are pockets of overvalue, and those are stocks that will be due a correction soon. But saying that, and I mentioned just now, we can anticipate volatility. Now, the people will have the strategy, what we call momentum investing, carry on chasing the stocks going up higher and higher, carry on chasing them higher, and maybe avoiding the stocks that are falling. That kind of scenario I mentioned just now. So the good stock pickers, those of you that are quite astute at picking stock, will still find value in the market, but obviously in selected stocks. We talk about nimble investors. I call them traders. You guys will benefit more from frequent opportunities. I saw this morning Harmony Gold shares, for example, jumped up 10%. Yeah, so that's why I think a lot of us will pick up opportunities is in and out the market in those scenarios. So saying that, we believe that the domestic listed property sector will offer opportunities. And we saw that one of the better performing sectors last year on the market. I think the property sector went up like 26% against the Aussies. I think it was 9%, so it was outperformance. But saying that if interest rates had to start going up this year, obviously that will present headwinds for capital growth, especially in the property sector. I anticipate maybe interest rates being kept lower for longer, but we'll talk about it a bit more later. Okay, but as long as you have what I call an appropriate investment horizon, talking about 3 years plus, I believe that you're in a situation where you'll make profits that will be outperforming inflation. Okay, so that's looking at the domestic market. Going internationally, PSG Wealth's view is that the global picture looks a bit mixed. Developed economies, their forward PE ratios seem to be overvalued, whereas the developing economies seem slightly undervalued. So economies like the US, I believe, is where the opportunities will be lying, as well as the UK. They should offer some opportunities in the medium term. Okay. So those are the sectors you may want to focus on. I like a ETF called DBX Trackers. This is from Deutsche Bank. You can have exposure to those markets through an ETF like the US or to the UK market, and add it into your portfolio. So that's how you can have exposure to those markets. Alternatively, obviously, take your money offshore, invest directly in those shares in those markets. Okay. So let's talk about the global economy further. The biggest thing this year, I think, that's going to add to the volatility is emerging market currencies. Okay, and if the emerging market currencies like the rand does weaken further, which would be great for foreign investors, and obviously that's where we can see money coming back into South Africa. From our point of view, obviously a weaker currency should benefit the exporters and things like that. But from a foreign investor point of view, that would be the biggest factor this year. I believe your money offshore, listed a global listed property should do much better than bonds and cash. Number one, because earnings yields are much closer to the historic yields, or the averages rather, and they're also trading at the marginal discount to their long-term averages. So yeah, locally we saw our listed property companies doing quite well. Now you can look at your companies that are listed here. They have shopping centres offshore, be it Capco, Capital and Counties, your Leppies, which is mainly properties in Romania and things like that. There's Rockcastle. There are quite a few companies that could have exposure to offshore. Okay, but saying that also, this is where you have to be cautious, especially in the listed property sector. Properties that have with high leverage. Remember, these guys they leverage up their balance sheet. And also companies that have limited liability, they can have severe consequences if interest rates start going up and things like that. So that's a big danger with this scenario. So saying that, let's look at scenarios. Okay, there's 3 scenarios, and obviously the base case is PSG Wealth scenario. The worst case scenario is that the US economy, or the Federal Reserve, starts raising interest rates. Okay, we've seen that we've come to the end of their quantitative easing program, where they stopped buying back bonds, obviously to keep interest rates down artificially low. It was all hinging on economic growth, and obviously the telltale signs of the economy starting to pick up. But if the economy is starting to pick up, or it starts overheating and inflation starts getting out of control, they will start raising interest rates. So the danger of that is that obviously it's going to put a dampener on housing recovery, number one, and number two, obviously economic growth. Okay. Saying that also that the alternative is that China suffers a big property bubble or a credit bubble burst. Okay, that can have a big impact on the market. But saying that, we only believe there's a 20% chance. That's the worst case scenario. Bull case scenario, 25%. Let me just get my little cursor here. My spotlight, 25% case that the Federal Reserve holds off on interest rate hikes, and I think has a very good chance of doing that. Corporate capital expenditure and obviously hiring, employment starts increasing, as well as wages start increasing. All these things will be bullish, and the housing will start picking up. There'll be a demand, especially from with the exports, our emerging market exports, and basically big growth. That's what we're looking for. Economic growth worldwide, everybody's happy. So that's a bull case scenario. PSG is saying we believe that the US growth will inch slowly towards 2.5%, and this is a 55%. This is how we view it. Feds will keep interest rates lower for longer, at least for the first half of this year. There won't be any more fiscal stimulus, okay, so the tax and things like that. Foreign capital inflows or flows or deficit to, we won't see this money flowing out of emerging markets. We'll see it maybe stabilizing, so maybe some money might coming back, but we won't have this giant outflow of all these of the market. So that should help the currencies as such. We should see low growth together with low inflation, which should keep interest rates lower for longer. Worst case scenario, or even better, we might have interest rate cuts. Okay, and yeah, we see the worst case scenario. We're talking about SAB, the South African Reserve Bank might increase it for another 50 basis points. I personally don't see that, especially with the inflation scenario. It all hinges on what happens with the rand. If the rand gets out of control. Okay, so that I hope you. That's if you had a look at. We're talking about the economy, global economic conditions. Let's go chunk a bit further now. Move one step lower. Let's move this out of the way. So I get my cursor back. Here we go. Okay, this is the economic impact on the markets. Again, the bullish scenario, equity markets sell off. Okay, sorry, the bearish scenario, the equity markets sell off on the back of raising interest rates. Okay, that's if the Fed starts raising interest rates, we should see we'll have this flow of funds out of the markets back into interest-bearing securities. If that happen, okay. Emerging market currencies will collapse. Obviously, this will trigger interest rates going up, and obviously real assets like property will also fall because of these higher interest rates. But things like the gold price, gold bullion should obviously increase as people feel insecure. That's a worst case scenario. This is if the economies get out of control. Bull case, cyclical assets like the stock market and things like that, or cyclical sectors like our consumer sectors would carry our markets forward, and then obviously that bullish sentiment will underpin that market momentum. Okay, higher highs, we cannot make higher highs as investors buying into the sectors doing very well. Okay, so the rallies will be quite sharp. Okay, our base scenario, with the volatility, we still anticipate obviously that the market will go up higher. Momentum will push the markets higher, especially the equity market higher. The repo rate, obviously with the low repo rate, we still anticipate into the market to do well, with the possibility of interest rates still pushing the market up higher. Doesn't matter. Okay, there'll still be a view for equity markets this year. Okay, we anticipate a subdued outlook, so we're not too excited about the economy this year. Profits should rise because of the weaker rand, so you should have a rand edge element in your portfolio. especially the big multinationals. So we saw this morning that breweries came out the results and the share price came down. If I remember rightly, I think the volumes only increased by when I say volume, the beer volumes only increased by 1%. So I think the market was disappointed with that slightly. So those big multinationals are, I believe, slightly overvalued. They are due for a bit of a correction. And those are the sectors that I mentioned just now. Well, those are the kind of shares that are making new highs based on momentum buying. Okay. So let's move forward. How does the market impact on specific financial products? So that you can bring in more of the unit trusts and all that kind of stuff. The biggest thing here in the best scenario that growth-orientated products, growth-orientated unit trust should generate losses in the short term. That is the worst case scenario. But the value-based unit trust should be better than growth-based growth assets. Equity portfolios with exposure to gold, cash, and defensive will do better. This is the worst case scenario. Okay. Yields on interest rate products are pushed even lower. So obviously as yields go lower, prices go up, and obviously markets do the opposite. Okay. So multi-asset portfolios should be obviously still the flavor of the month, but will be more conservatively positioned. Okay. So that's a worst case scenario. The bull case scenario is growth-orientated products should generate significant real return. So again, it goes back to that momentum investing. Let's chase the hot stocks. Okay, the sectors are in flavor. Okay, the retail sector will still go up higher and higher. Equity portfolios with exposure to the cyclical sectors like the retailers and consumer-facing sectors should still do well this year. Okay, so that's the bull case scenario. PSG's base case scenario: equities carry momentum forward, as I mentioned a few times already, despite obviously the high volatility market. So those of you that can't stand the volatility, maybe you need to become a bit more defensive this year. I like the food companies a lot. People still need to eat, and I still believe there's opportunities there. So you might have to become more actively managed. The portfolio has to become more actively managed, and from a risk point of view, obviously more well diversified if you want to outperform the market. Okay, this is a stock picking market we're moving into. I don't believe there's much value. There is value on the resources stocks, but then you have to wait for that recovery if it does happen in that sector. Money markets, instruments should start moving up if interest rates start going up, but I anticipate that we're down the line. Okay. Multi-asset portfolios will offer a much better balance. Okay, obviously motivate. When I say multi-assets, obviously a spread between equity, property, and interest-bearing securities, that kind of stuff. So that kind of asset class, you look at ETFs or ETF that are that kind of style, they should be more popular to compensate or beat that volatility in the market. Okay, to produce that return. So guys, I know it's a bit difficult to try and the three scenarios together. But if I had to just summarize it quickly, obviously there are political challenges going forward. We're seeing this year, or especially 2016 being another election year, so there'll be a lot of, what do you call it, political shenanigans going this year already. There'll be interference and more corruption and things like that. There'll be economic challenges, especially from a growth point of view, but more importantly, obviously, job creation. But bottom line, I believe the big theme this year is volatility. You need to deal with volatility going forward. Okay. So in summary, I believe they need to become a more defensive, a more astute stock picker. Saying that either that or becoming more defensive. I like it, as I say, I like the property sector. So that's one side of the coin. Another side of the coin, maybe start looking at taking your money offshore, opening up an offshore account with PSG, investing in the US market or the UK market. I believe that's one way of diversifying geographically. Okay, you need to manage your risk. That's where when I say risk is money management and risk. Create a balanced portfolio. Have some financial shares, industrial shares, and resources if such, but it must be diversified, 3 to 5 different sectors. Okay, so from our side, Only thing I can say is good luck in navigating the markets during 2015 and happy trading. Okay, let's see if there's any questions coming through here quickly. That's what I mentioned just now, but you guys are not seeing my slides. Crap, man. There's the poles are causing a problem. Oh, gee whiskers. Okay, well, that'll be the last time I use a pole. I don't know why it does that. Oh, gee whiskers. So you guys had audio again. Ah, man. Okay. So yeah, I'm only looking at the questions now. So guys, I can sincerely apologize again. Well, gee whiskers. Well, that's the last time I used poles. Looks like it's always a problem with poles. Okay, looks like that was a general thing there. Well, that's how it goes. After like 5 years of doing webinars, and now we're still having, I'm having all these problems. Here's our coming up events, guys. Next week, Wednesday, we've got a webinar. We're going to talk about trading for a living. I've had a lot of interest in this. I just attended a very good trading course over the weekend from a big international trainer from the States. Some of you might have heard of him, Courtney Smith. And the whole thing was talking about trading for a living and how to use just to trade 15 minutes a day and be able to trade for a living. Quite interesting. But obviously this is some other books and courses I've done. So we're going to just talk about trading for a living. What do you need? What's the mindset you need and things like that. Beginning of February, we're talking about investing like the best. We'll talk about the Warren Buffetts, the Peter Lynch's of the world and things like that. Okay. And then end of February, at this point in time, should I invest offshore? We've touched really briefly on it now. I believe there's opportunities there, and I believe that you must be investing offshore. Next week, Tuesday, I'm in Cape Town, and very similar to the talk we're doing now. What can we expect this year? So we're going to talk about some trends, and there I might be highlighting some stock picks in that. So I appreciate the guys in Cape Town. If you guys can maybe start preparing your watch list, and let's talk about your stocks in your watch list, okay? And in the beginning of February, we had the Brighton Country Club. We'll be talking about investing and trading part-time. I think a lot of us are in that boat. How do you polish the strategy? What are the steps? Okay. So guys, from my side, I can only really again apologize for the slides sticking. Obviously, it must be those polls. So I won't be using them again. So this ends up as being another auditory. But you guys will be getting the PowerPoint presentation, so you can just match it up to my to the voice as such. Okay. So guys, thanks a lot for participating. I hope you found this interesting. And until next week, we'll see you again. All the best. Bye-bye.